Well, good afternoon, everyone. This is Tony Whitbeck. I'm the CEO of Key Management Group. And with me today, I have Todd Doherty, who's our Director of Acquisition and Legacy Planning. And I also have John Turner with Live Oak Bank. And as you can see, the title of the first part of our presentation is around practice valuations. And so Todd's going to take us through that content. And then we're going to turn it over to John, and he's going to talk to you about how to finance a deal and how Live Oak Bank works in terms of their financing. Before we get started, though, I'd like to spend just a minute telling you about some of the services that we offer at Key Management Group. And really, we bucket them into four different categories. The first is our practice management solutions. Then we have our outsourcing. Then we have our human resource and risk mitigation. And then lastly, our acquisition and legacy planning services. And one of those services includes business valuations, which is what we're going to talk about today. So under practice management, we have our strategic leadership package where we work one-on-one with the owner of the practice to help them grow their business. It's more of a strategic partnership, and we're going to help look at all different areas of your practice to see where there might be some areas for improvement. This typically involves a bi-weekly or monthly meeting with one of our executive coaches. We have our operational performance package, which is where we identify 2 or 3 pain points within your practice. And then typically over a 4 to 6 month time frame, our practice management team will help you resolve those issues to run a more efficient and effective practice. The third is our complete practice management solution, which is really a combination of our executive coaching and operational performance package. And this is where we bring all hands on deck to help you really restructure, reorganize your business from an operational standpoint and to work with the owner of the practice on strategy. The second area is outsourcing. So for advisors that are Ameriprise, we do client meeting preparation. We do about 300 client meeting preps every week for advisors. And we do financial plan production, and we do about 1,500 financial plans over the course of a year. The third area is our human resources and risk mitigation services. And we help advisors with recruiting and onboarding and offboarding, help them put together the HR files and compliance systems. We'll help with employee handbooks and policies. We do a lot with AFA compensation and incentive structures. In fact, we have a whole new service that's an AFA analysis where we look at both the financials in hiring or changing the compensation for an existing AFA, as well as the risks associated with that, and ensuring that you're classifying them the correct way and that you've reviewed all the regulatory, legal, and franchise ramifications of that hire. And then we also have an HR assessment and a risk assessment for your practice. So a lot in this particular area. And then finally, we have our acquisition and legacy consulting services. We have our business valuations, which you're going to hear about today. We have a turnkey continuity plan, and this is where we can provide you with a evaluation of your practice and the legal agreements to protect the value in the event of your death or disability. Then we have a deal-making service, and this is designed for advisors who have found each other, a buyer and a seller, but they need help valuing the practice, structuring the deal, and then putting the legal documents in place to consummate the deal. We have an escrow service that we often use with Live Oak Bank and other banks to basically escrow a portion of a sale, typically for the attrition clause, and so we offer that as a convenience to our clients, both buyers and sellers. And then we do a lot in the area of practice sales. So we have our platform called Advisor Legacy, and our Advisor Legacy platform allows us to represent sellers and get interest from potential buyers. And then we eventually have our sellers select who their buyer is going to be, and then we help with the transition. That's a very, very popular service, especially when people aren't sure who they want to sell it to. And then in that same program, we have our Elite Buyer program. And this allows some of our buyers to upgrade their status and to create a profile about themselves to make them more attractive to the sellers that are on the platform. So as you can see, it's pretty comprehensive. We do a lot of different things. There's very little that we can't do in the financial services business. We have nearly 30 employees at Key Management Group, and we work with over 100 practices on a regular basis through our coaching and practice management services. So that's a little bit about what we do. Before I turn it over to Todd, I would like to judge our audience a little bit, so I'm going to ask you a couple of questions, and you're going to be able to answer these questions on the screen. So this is the audience participation point. So if you've been multitasking, if you could put your eyes back on the screen for a second, I'm going to ask a couple of questions, just 3, and then I'm going to turn it over to Todd. All right, so the first question that I have for you is, have you had a formal business valuation in the past 12 months? A simple yes or no. So if you could please select the answer. And we're still waiting on a couple of votes. Whoever that multitasker is, we got to get that last vote in. Oh, okay. Well, here we go. 100% of you have said no. You have not done a business valuation in the past 12 months. So this first half of the presentation should be very important to you. So let me ask the second question here. And the second question is, how accurate are valuations using a rule of thumb? Are they very accurate, somewhat accurate, not at all, or if you're lucky, pretty accurate? Again, time to cast your vote. Got a few people that are multitasking. We need your votes. And I'm going to close it out. And the answer, 100% of you said it's somewhat accurate. Well, I would say if you're lucky, it could be pretty accurate. But what you'll learn here from Todd is that the rules of thumb are really a very dangerous way to consider what the valuation of your practice might be. Here's the last question. There we go. Why have you, or in this case, would you do a valuation? 1 is for equity management, 2 would be succession planning or retirement, and 3 would be continuity planning for death and disability. So why would you consider doing a valuation even though you haven't done one in the last 12 months? This is the time I need everybody to please cast their vote. There must be something going on in the market right now. You guys are slow to vote. Must be looking at your TV or Quotron or something. We need a couple votes in here. All right, I'm going to close it out. I can't wait for everybody. And 100% of you says for equity management. We did have quite a few people not vote, so statistically, probably not very accurate. All right, so with that, I'm going to turn it over to Todd, and I'm going to let Todd walk you through the rest of the presentation. And Todd, if you could please confirm that you can see my screen. It shows that people can. So Todd?
Yes, I can see.
Great, thank you. It's all yours.
All right. Thank you, Tony, and thanks to everyone for taking time out of your schedule to join us today. If you could just advance that from the polling there, Tony. One of the things that we've noted over the years is that there's a lot of misconceptions around practice valuations. You know, what is being valued, what is the methodology of value, and so forth. And so I thought I would start out just trying to gain a common understanding of what is being sold when a financial planning practice changes hands, and as a result of that, what the focus and methodology of evaluation should be. So a sale of a financial planning practice is an asset sale, and the asset is the goodwill of the client group for the most part, to a lesser extent, the goodwill of the selling advisor who is going to encourage the client group to move over to the buyer. That goodwill, if you will, really provides a number of things. First of all, the client's assets under management that are currently being managed by the seller. Certainly the revenue produced from those assets. Also, the goodwill of each client, in as much as you'll find new opportunities with those clients and also referrals to other clients, is part of the client goodwill. So if you think about that being the primary value in a practice, and the fact that you don't technically own the clients, they can come and go as they choose, it really is the client's goodwill that you're working with, and that is being valued. As a result of that, the large focus of our valuation methodology is really around the quality of the client group. And we'll talk about more specifically how we determine what the quality of the client group is. Secondarily, and this has been more common since practices have become larger and larger, there's an element of what's known as enterprise value that's largely focused on the efficiency or inefficiency of the practice and the resulting profitability. And again, that's become a more heavily weighted area of focus of the valuation as practices have gotten larger, and when those practices sell, it's really the enterprise that's being sold, not just a client group, if you will. And the buyer is taking over the operations of the practice. They're taking over the staff, which is a significant expense. Oftentimes, the office locations and so forth as well. And so that element of value, again, is known as enterprise value. So let's take a look at why people get valuations for their practices. And there's actually quite a variety of reasons. It's not simply for succession related topics, although that's certainly one of the larger reasons that we do valuations for advisors. So as Tony mentioned in the questions, one of the reasons that you would get a valuation is to measure the growth of the equity in your practice and manage that equity. And certainly that's a very good reason to get a valuation. I think, we get the question a lot, how often should I get a valuation? If it was my practice, I would certainly want to do that on a regular basis, preferably on an annual basis. A valuation is generally the starting point for any type of a continuity plan or buy-sell agreement, that being protecting your practice in the event of death or disability or planning for a future sale. It's becoming more and more common that we're doing valuations for equity sharing or for creating partnerships between two advisors. It didn't used to be that common, but again, we're seeing a lot more larger enterprises with relatively complicated equity situations, and they certainly need to figure out how to divide the equity or how to combine practices into a single enterprise. As I mentioned, it's certainly the starting point for any discussions around succession or acquisition. Many of the banks, like Live Oak Bank, do require a valuation as part of their underwriting process. Some of the other reasons not listed here, and I think one of the most important to me, is that a valuation can really help you manage the efficiency and profitability of your practice. One of the parts of the deliverable of our own valuation really focuses on what those efficiencies are, how you can improve the efficiencies and how they relate to the profitability, and we can compare your practice to other practices of similar size to show you if you're more or less profitable and efficient, and how to make improvements to move up into the top range of those areas. Most people are not familiar with the fact that there are different types of valuation deliverables depending on the need of the client. The most common in our industry, and the one that most advisors are familiar with, which is also our standard deliverable, is what's known as a calculation engagement. And these types of valuation deliverables have been determined by the American Institute of Certified Public Accountants. What a calculation engagement describes, and I think the name is a little unfortunate, it makes it sound like it's a simple formula, and it is not. It refers to the fact that the valuation analyst has custom designed the parameters of the valuation. And it's very applicable to our own industry because our valuations are extremely industry specific. I mean, we know every detail of the management of a practice and the clients and so forth. So we can be much more industry specific than other valuations for other business verticals. There are other reasons why you would get a valuation, and again, that valuation reflects what's known as fair market value. But not all valuations are reflective of fair market value. For example, if someone needs a valuation for a divorce proceeding, that's a very specific deliverable that's also governed by the state laws. It's not reflective of fair market value. If people are dividing up the equity in a practice, that's a limited marketability and minority ownership situation, so that's not fair market value. And all of those types of deliverables that we refer to as specialty valuations have a very specific methodology and a different type of deliverable specific to that methodology. We can conduct any type of valuation, even outside of our own industry, as we have a certified valuation analyst on our team who's also a certified public accountant, and he does all of our specialty valuation work. So Tony asked a question at the outset around using rules of thumb for valuation, and it's a common question that we get from advisors, and we always have since we've been in this business. Is what are the multiples of revenue? What are multiples currently for recurring and transactional revenue, or what's the average valuation today? And those questions are fine, but unfortunately, we also see people using those rules of thumb or benchmarks, if you will, for the purchase or sale of a practice, and that's where you're really taking a big risk and substantial amount of risk in terms of dollars. So we do a study basically at the end of each year, and we look at all of the valuations that were completed in that year. And as you can see here, for the last 12-month period, our average valuation result was $1,531,000. The average size practice for that valuation had 100 million of assets under management and GDC, or gross revenue, of 764,000. What we also look at, and this is what's relevant to the rule of thumb question, is what were the bottom and top 20% results. And so if we take that average size practice and look at the bottom 20% result, that valuation comes in at $1,374,000. If we look at the top 20% result, the valuation comes in at $1,759,000. So the range of value applied to an average practice turns out to be just shy of $400,000. So you can see, if you were to use the average, again, if the practice was average, you might be lucky and only be off by a few $1,000s, certainly far more than the price of a valuation. But what you can also see here and take away, hopefully, is that it wouldn't be too difficult for you to be off by $100,000 or more, again, for an average size practice. And it's certainly not worth taking the risk of using those, benchmarks or rules of thumb. I had an advisor who purchased a valuation earlier this summer. He was a seller, had a deal, he had an offer in place, thought it was a reasonable offer, thought the buyer was a great fit and everything, but he figured, I should just get a third-party valuation just to be on the safe side and have the peace of mind. The valuation came back. It wasn't terribly different. It was about $150,000 more than what the offer was. And for his size of a practice, it wasn't a huge deviation, but in dollars, it was significant. He took the valuation back to the buyer and said, here's a third-party valuation. And they offered to meet that price. And he came back to me and said, that was the easiest $150,000 I've ever made. And, for an investment of $895, it was worth every penny of it. So certainly take the time to get a valuation whenever you're doing something significant with the practice, buying, selling, planning for the future, et cetera. It's certainly well worth the time and effort. So there's two different methodologies of value that are commonly used in the industry. Most of the valuation vendors that you're probably aware of use one or the other of the two, and we use both. We feel both are significant. They represent different areas of a practice that are important, and so our valuation deliverable is based on the average of the result of the two methodologies. The first methodology is what's known as a market approach. And what we're doing there is we're looking at the key metrics of the practice, comparing those to our benchmarks or averages. And by doing so, we can determine, where is the practice above or below average. And through that, what is the overall quality of the practice? And then we can compare that to the sale of similar practices. And that's basically how most people conduct a market-based approach. Then we also use an income or earnings approach. And what we're doing there is we're valuing the future revenue stream of the business discounted for time. And the things that we look at there are the expense ratio of the practice, a growth assumption going into the future. So we'll look at a lot of the key metrics and determine what the long-term future growth of the practice might be. And then also, what are the risks and opportunity costs? And so we'll have to just decide on a discount rate based on what the relative risk of the investment would be to a buyer. And in that respect, you'll look at things like client age. Certainly a higher average age is a greater risk to the buyer. You might look at asset velocity and other, key areas of the practice that would represent an increased or decreased risk. So those are the two methodologies that we use, and they're also the two common methodologies that you'll find for valuations in our industry. You might ask how we determine the quality of a client group, and there are certainly several ways to do that. But one of the primary ways that we do it is by analyzing client segmentation. So we break down the client group into three different groups. The first are what we refer to as basic clients, those being under 100,000 in AUM. Second group are high value clients between 100 and 500,000 in AUM. And then the third are affluent clients who are 500,000 and above. The real significance of client segmentation is that it has a very high correlation to profitability. And it's really focused on the basic client group. As you can see here on the slide, the basic client group for an average practice represents 44% of the clients, but they produce only 7% of the revenue. The opposite is true on the upper end clients, while you can see that the affluent client group at only 18% of the clients produces over 60% of the revenue. So it's very much a Pareto principle or 80-20 rule where, most of the assets and most of the production is in the upper end of the book. Unfortunately, it is that basic client group at over 40% of the clients that creates an inefficiency, because you're servicing and spending time with those clients and they're representing very little of the revenue. And what we also see as practices get larger, they tend to become less profitable on average for the same reason. And specifically what we see is that advisors will hire an associate to service the bottom end of their book. And then when they do that, they've created their largest expense item relative to their lowest productivity. Oftentimes that's duplicated, and sometimes very large practices have very poor profitability as a result of that. So managing client segmentation, being in the upper ends of efficiency and respect to it, are generally how practices can become really above average in profitability. Some of the other key metrics that we look at, we get a lot of questions about these averages, and these will also show you, what the, kind of what you're being compared to in evaluation, what the averages are today. And in some cases, these have changed over the years, and in some cases the bar has been raised a bit. So you can see here, just kind of going quickly through these, the average client group GDC is currently $3,600. In the top 20%, you're in excess of $4,000. At the bottom end, around $1,400. Average AUM currently around $380,000, up to around $500 at the top end of the client size, and as low as under $200,000 on the bottom end. Recurring revenue is one that we've seen a really sharp increase in a fairly short period of time of only about 3 years. We have moved from an average recurring revenue, which was pretty consistently in the high 70% range. And today, it's even increased since the slide was made. It's about 87%. So we're really seeing a big increase there. And again, that's kind of raised the bar of what we're comparing practices to now. Average client age, as you can imagine, continues to increase. And currently, the average age for all clients is actually 61 years. For your high net worth and affluent clients, it's about 65 and 66 years, respectively. That's a very significant factor in respect to value, and especially when the clients start to reach an average that's close to 70, and that can apply specifically to the high value and affluent clients, it really becomes a tipping point in value where it's very difficult for a buyer to assume any type of long-term growth rate for those client groups, because the likelihood is that they'll have a shrinking asset base. So again, our valuation process, we use the 2 different methodologies of value. As you can see here, we also have a discounted price for our partner firms. So the standard price is $12.95. Partner firms, which are Ameriprise Financial, Cetera, Northwestern Mutual, and Raymond James, receive the $400 discount. They get the price of $8.95. And one of the best parts of our deliverable is that we spend an hour going through the results with you. So whatever the reason is that you purchased the valuation in the first place, we want to make sure that you know how to use the information in the report. We don't want you just flipping to the page that has the value on it, and that's the extent of it, because there's a lot of great information throughout the report in the analysis, and we really want you to be able to use that to achieve your goals, whatever they were. And I think most of our clients find that that's the most valuable part of the deliverable in the process. So with that, I'm going to hand it back over to John Turner from Live Oak Bank, and he's going to talk about how you finance a deal.
Hey, Todd, before we turn it over to John, I just want to let our viewers know that if they want to purchase a valuation, they can go to directly to our website at keymanagementgrp.com. And then under services, you're going to see assess your practice, and then another drop-down menu is going to come up, and you click on business valuations. You can purchase it right online with a credit card. Once you make the purchase, you'll receive a confirmation email with instructions on what to do next, and it will contain a link that will take you to a questionnaire that you complete, and then attach a few documents, and then we're good to go. And the valuation turnaround time is typically 7 to 10 business days, so it's quite quick. So if no one on the call has had a valuation done in the last 12 months, so this is extremely applicable to you. And so at the end of today's presentation, I'd encourage you to go to our website and make that purchase. So I will now turn it over to John, and John is a senior business loan officer with Live Oak Bank, and Live Oak Bank has been a strong partner of ours for many years. And I'm going to turn it over to him, and he's going to talk to you a little bit about financing the deals and how it works at Live Oak Bank. So, John?
Great. Thanks, Tony. I appreciate it. Todd, it was great hearing your presentation. One of the interesting things I will say about valuations, and another reason to think about getting one at least once a year, is when we see deal structures these days, we'll get into it in just a minute, but when we talk about the equity injection, there's 2 ways to solve it. One is cash. One is the bank just simply gets to count the equity you're bringing into the deal. Having that valuation done once a year gives you a sense of the size of practices you could actually go look for and acquire. And I think it's an important part not only of your business planning for your organic growth, but also for business planning for your inorganic growth. So completely agree with both of you that an annual valuation done by Key Management is very important to complete. But with that said, let's talk a little bit about Live Oak Bank. Again, we are the only FDIC-insured national bank that was specifically chartered to do cash flow goodwill lending to investment advisors such as yourself. One of the things I'll point out on this slide is just off to the far right, we work in a number of industries. We all do kind of stick to our knitting, if you will. I work with investment advisory. Todd knows I started my practice back in the mid-'80s, and I've spent 32 years either as an advisor or a practice management guy. But if you end up having folks that you work with that are business owners and they're thinking about their own succession plan, you have a new arrow in your quiver in terms of being able to help them execute on that with financing if they fit one of those verticals off to the right. Now, as we talk about our own mix of different kinds of financing for investment advisors, we need to update this slide. It's 600 million now, so it continues to grow month over month. But we finance in all these different areas where you may have potential business expenses. The outlier here would be commercial real estate. Those are 25-year term loans. All the other loans that we do, including acquisition and succession, are 10-year term with no prepayment penalty, so you can pay it off anytime you want. And in fact, if you pay a little ahead, the loan actually re-amortizes and your payments drop. So you can actively manage cash flow. And one of the things that we're going to talk about, and you're going to hear about today over the few minutes we have together, is all about cash flow. For a cash flow goodwill business, cash flow matters. What drives cash flow is not rate. You know, we kind of really got rate beat into our heads from the double-digit days of mortgage financing in the late 70s and the early 80s. But it's term. So we'll really talking about term and how that helps drive your cash flow. But turning our attention to really kind of the components of the deal and how they work, there's really three parts of a deal: price, taxes, and terms. And they all work in inverse relationship to each other. Price, Todd did a great job talking about that. What I would just add to that is that multiples do not equal valuation, do not equal final price paid. A lot of that has to deal with deal structuring. And again, Key Management Group helps with coaching on that and consulting on that to try to get a fair deal for all involved in it. Taxes, another very important point. They're negotiated. There's 4 different taxes. There's tangible property or tangible assets, hardly ever used. There's the bulk, which is usually under goodwill, and that's, of course, the long-term capital gains. There's consulting, which is really the hard work that the seller is going to do to transition the practice, and that usually we see a small bit of the deal around that. And then the final tax category is protective covenants, and that's for the non-solicit, the non-compete, the no-serve clause, and the one that we've seen very prominently lately is the do not disparage, and that's been a very important one. But you have to have enough of the deal allocated to that if a judge has to be involved, they would deem that it's enforceable because there's enough valuable consideration there. So you can explore more of those tax ideas with Tony and crew. But moving on, we're going to talk about terms. That's really how a deal gets paid. And there's really 4 categories, 6 ways within 4 categories that you can get paid. Earnouts, we don't see a lot. Not like we used to back in the day. And I think it's mainly for a couple of reasons. One, usually earnouts are taxed as earned income, subject to state, federal, and maybe FICA and Medicare. Also, many of the broker-dealers out there, and now some of the state commissioners for the RIA side of the world, are concerned about keeping someone on and having to have to continue to supervise them after a deal has been done. So we don't see a lot of those. But if you get involved, there's really 2 types. There is the first one, which really is sort of a period certain, I'll call it. And that basically is maybe I owe you $1 million. I'm going to pay you 30% of the revenue over the next, let's call it 3 years. And if you have feast years, maybe you pay more than $1 million. If you have famine years, you might pay less. But that's one way to do it. The other way is fixed price or fixed amount, which says, I owe you $1 million, I'll pay you 30% of the revenue till it's paid off. And if it's feast years, maybe you get it done in 3. If it's famine years, maybe it takes you 5 to get it done. But that's really how the earnouts work. A cash, that's the way that hurts sometimes. We really see cash used mainly in the very, very small deals, say $150,000 and less. is often where we see cash. On seller notes, we see two types there. Fixed, it is what it is. It's just the rate is fixed, the amount is fixed. Just for your own information, the average length of a seller note that we saw last year was 5 years, and the average rate on it was 5.25% is what we saw. Now, variable is the rate doesn't vary, but the principal varies. And this is where you see the clawback sometimes embedded. So it might be, I owe you $1 million, I'm going to pay you in 120 monthly installments, but we'll check it after the first year. And if all the assets haven't come over, then perhaps we adjust the principal. I no longer owe you $1 million, maybe I owe you 900,000, something along that line. So that's what we see there. And then lastly, you have bank notes, namely Live Oak. So there's a whole different ways to kind of think about bank notes. Some people do ask for rates, and so I'll just mention that very quickly too. We do fixed and variable. We do conventional financing and SBA. If you do a 2x2 matrix, you'll see there's a check in every box. We tend to do what works best in any particular situation is how we work that. But the structures really have changed a lot. When I worked in practice management, what we would see as a standard deal structure would be 1/3 down, 1/3 in an earnout, 1/3 in a seller's note. Well, that has changed dramatically, and it has much to do with a change that took place in the banking regulations in Q1 of 2017, which allows for 100% financing. And we have seen a significant movement to going to 100% financing, leveraging an escrow account. And I'll talk about that in just a minute. But I think the reason why we're seeing that is that for the first time in deal making, both buyer and seller get to manage their risks down to near zero. Usually someone has to bear the risk. Either the seller bears it by doing a seller note or an earnout, and they can ask for a premium, or the buyer bears the risk by coming in mostly with their own cash, and they could talk about a discount. But for the first time, as I've said, both buyer and seller get to manage down their risk. And let's talk a little bit about that in the next slide here. The way these are structured, by the way, as we're getting into this, is that usually if you go for 100% financing as a buyer, you generally won't give the seller all the money up front because you would really like to have their enthusiastic support with the transition. And often that includes putting in place some sort of an adjustment or a clawback. When you're using 100% financing, that involves an escrow account. And by the way, Key Management Group has a great escrow service that they can use. But let me just kind of talk through how it works. So on the day of close, all the money would pour into an escrow account. That escrow account has to be the seller's agent, but all the money pours in there. And per the escrow agreement, some percentage gets released on day one. We usually see 50 to 75%, with the rest held back pending successful transition. And sellers love that word pending usually, because that means that's going to be contingent receipt of funds, which means it's going to be taxed in the year that it's received. So sellers enjoy that. So what do sellers get? Well, they get to offload all risk of non-payment to the bank, and then they get some preferential tax treatment. So they get the time, what will be mostly long-term capital gain. So sellers are pretty happy. Well, how about the buyer? Well, let's fast forward just a little bit. Let's assume it's a year or so. The transition period is done. If things went well, the escrow is released to the seller and everybody's pretty happy. But what if things didn't quite go as planned? Perhaps you're going to receive some of that money back as the buyer per the escrow agreement, maybe some or all of that escrow. And of course, as the buyer, what would you do with that extra money? Well, you'd put it back into the loan. There's no prepayment penalty. And what does the loan do? It reamortizes and the payments drop to be commensurate with the revenue you did receive. So you get to manage down your risk of attrition to zero. The other thing that you get to do as a buyer is manage your other risk. Buyers have two risks, sellers have one. That other risk is that you've done a deal where the terms aren't great and you have a negative cash flow, and here comes a market correction. And as we said, term really drives cash flow. In this instance, everything is on 10 years, so that the deal generally cash flows positive in year one. It's accretive. You're actually stronger, more resilient, more robust if there is a downturn in the market. So you get a chance to manage down that second risk as well. And I think that's why we're seeing the significant draw to the 100% financing using an escrow account. But it's not for everybody. There's actually 3 hurdles that have to be met in order to really secure 100% financing. The first one is that, is the loan size. It is limited to the third-party valuation. As we've talked about, you're going to have a valuation done by Key Management Group, and they'll have a front page number. It's the baseline valuation, and we can finance up to 100% of that baseline valuation. Now, I'll always say that, if the seller is just crazy enough to ask for more than what it's worth, and, if the buyer is just crazy enough to pay it, then that would be a seller note on top of the bank note to make that happen. On the next slide, we'll talk about equity injection rule and how that works. And this actually is where there was a change in the banking regulations that I talked about. But we do look for a 10% equity injection. There's really 3 ways to do it. The first way is that you could bring cash to the deal as a buyer. And it's really 10% of the deal. So not 10% of our loan, 10% of the deal. You could bring cash. The second way is that you could split the responsibility with the seller, where the buyer brings 5% cash and the seller takes a seller note for 5% of the deal. They can charge whatever interest rate they would like to charge, but it would be on full standby, meaning interest would accrue, but no payments for principal, no payments for interest would occur until the Live Oak Bank loan is completed. On the outside maximum, that would be month 121, it could start. Obviously, if the buyer pays the bank loan off quicker, they could start in on that seller note quicker. And then the last one is you simply get to leverage the equity the buyer already has. And here's what I mean. Let's assume that as a buyer, your business is worth $500,000. Again, how will you know that? Well, you would have had a valuation done by Key Management Group. But let's assume that it's worth $500,000. Let's assume you're buying a practice worth $1.5 million, 3 times your size. Well, we would assume that the newly merged business would be worth about $2 million, of which you would already own $500,000. That's a 25% equity injection. So it's solved, and we could finance 100%. And that's where the banking regulations had changed in Q1 of 2017. But there's a third hurdle that we'll talk about here on the next slide, and that is that you actually have to qualify for the loan. So let's talk about really the 3 ways that you qualify. First, we do look at your personal credit report. We will look at the lowest of the 3 reporting agencies, and we'll look for a 680 or higher. And again, if you have a couple of late payments, we can swing with that. But if you have any of the bad stuff, bankruptcies, foreclosures, tax liens, defaults, that usually is a hard stop for us. The other one here is the debt service coverage ratio of 1.75. And here's the best way to explain this, is you're not a coffee shop. You don't have coffee equipment to collateralize, and I'm not going to count that swell Keurig in the back room. You're a cash flow goodwill business, so we're going to pay attention to cash flow. In fact, we'll contemplate what will your future merged business look like and what will be its ability to pay business debt. And at the highest level, we're going to take total revenue minus total expenses minus owner's compensation. That whole thing, if you put it in brackets, divided by 1.75 for the safety margin. And what that equals is essentially the largest business debt payment your business can support. And I'll break those 4 elements down just a bit. Total revenue, that's your revenue plus the 10% or 90% of the revenue you've acquired post-grid. Expenses, that's your expenses plus any expenses you may have inherited. Owner's comp, you can pay yourself whatever you want. Frankly, we don't care. But what we'll do is we'll use the larger of $75,000, so that's the floor, or we go back to your personal credit report. We look at your personal debt payments, your house payment, car payments, credit card. Then we add that up and we double it so you can also pay for personal expenses like birthday gifts and groceries and annualize it. And whichever number's bigger, the $75,000 or that, we'll use, and we'll subtract that out as your owner's compensation. So you do that formula, total revenue minus total expenses minus owner's compensation, and the result, divide it by 1.75. That's our safety margin. Because we wouldn't want to take absolutely everything that's left over as profit from the business, because what if there's a downturn in the market? We could leave you in a really bad place. So that safety margin of 1.75, not quite cutting that in half, gives you some breathing room in case there ever is a downturn in the market. So that's really how that works. And the third and the last or final way that you qualify is you got to be in the business for at least a year, and you have to be in good standing. It doesn't mean that you don't have a couple of client complaints. Clients can complain for any reason at all, but in general, you're doing well in your business, and you've been doing it for at least a year. So that's really going to be kind of the points on how you qualify for a loan. Beyond that, let's talk a little bit about this whole notion of term. I want to play with that for just a few minutes. And again, rate has a bit of an impact. Term has an incredible impact on your cash flow. And so let's just look at this example. So in my example here, the advisor will be generating $800,000, and it's post-payout grid. I'm keeping my math simple. They're acquiring a practice that generates $600,000 post-payout grid. There was a valuation done, and it turned out to be really strong, and the price paid for the practice was $1.5 million. The buyer has expenses of about 40% of the existing revenue, so 40% of $800,000 will be $320,000, and they accept $120,000 in expenses from the acquisition, probably some staff and perhaps some lease payments. And then the owner's compensation came out to $250,000. The seller's asking for a 5% interest, which is a little bit lower than the national average last year, on a 5-year note, which was typical for last year. And then the Live Oak Bank loan will be prime plus 2 over a 10-year term with no prepayment penalties. So we're going to look at 3 scenarios. The very first one here is where the seller is financing 100%. And if we just blow that up a little bit, you'll be able to kind of see the numbers here. So 100% financed, what does it actually look like when you crank through all the numbers? Well, the debt service, as we call it, would be $340,000 per year to pay on that seller note. And when you calculated out all the income and the expenses, in this instance, it's cash flow negative in the first year by $110,000. And so this is sometimes where I'll say that tongue-in-cheek comment of you're now eating ramen noodles and hoping and praying that the market doesn't go down for a little while. But that's how this works. But let's try another one. Let's try it where it's, again, 50% seller note and 50% Live Oak Bank, and let's see how this turns out. Well, in this instance, again, seller financing, it stands to reason, $170,000. That's half of the $340,000, and you'll see here that the Live Oak Bank note came out to $107,000. What's interesting about this is, but wait a minute, the seller note is 5%. The bank note is prime plus 2. Prime's at 5.25. That's a 7.25. No, that's almost a 50% increase in the interest rate. But it didn't have the same impact as term did. It's $107,000 for the Live Oak Bank note. But in this case, we're still negative cash flow, about $47,000. Well, let's take a look at it with the 100% financing with Live Oak Bank. And again, what you'll find here is that the debt service coverage ratio now, or the debt service coverage, is $215,000. That's for the Live Oak Bank note, 10 years, prime plus 2. And in this case, it's actually accretive. There's a positive cash flow from year one, and it just grows stronger and stronger from there. So again, just an example of the power of term, that really does drive cash flow and makes a big difference. So how do you get a loan with Live Oak Bank? Let's talk a little bit about the process here very quickly. As you're working with a potential seller, if you're a buyer, or if you're a buyer, if you're the seller, as the two of you are starting to come together, early as you can in the process, you would give me a call. And we'd want to talk through kind of how you're thinking about the structure of the deal. Reason for that is we want to make sure it fits with banking regulations and it's something that could be bankable. Also, early on in the deal, as soon as we have a sense of what the revenue that will be acquired and the expenses that will be inherited, we'll get our calculators out and we'll start doing some what I call hand grenade math, really kind of calculating the cash flow and what that's going to look like. And are we close? Are we in the ballpark? If it makes sense, we can also do a letter of interest, which is very similar to a pre-qualification at that point in time. But there will be a point where the buyer and the seller are ready to take the next step. And usually the indication of that is the seller's ready to share 3 years of tax returns and production reports, because we'll need that for the underwriting process. And when you hit that point, the buyer will send an email to me at john.turner@liveoakbank.com, and I will get them set up on the system, and I'll send an invitation to our automated workflow called Portal. And that second dot there, forms, documents, and signatures, it'll take you about 90 minutes for you to do your forms, 5-10 minutes on the signatures. You will upload the documents that are listed there, including 3 years of tax returns and the production reports. Now, once we have everything in, we'll do some underwriting. Now, it won't be complete underwriting. That takes a couple of weeks, but in a couple of days, we can get enough underwriting done to get to a 95% confidence level. And we'll send out a proposal letter. That's the third dot that you see there. And what you'll do as the buyer, as the borrower and buyer, you will take a look at that and you'll ask yourself, does this make good business sense? And if you feel it does, you'll go ahead and accept, and then we're on our way into underwriting. Underwriting generally takes about 10 business days. And you'll meet an underwriter, and their job is to tell the good, accurate story of the case for the credit officer. And once that is done, we move to acceptance, and that's where the case is submitted to the credit officer, most powerful person in the bank. They stand at the vault, and they constantly are asking, can she, will she pay us back? Can she? Math and science. Will she? Total gut level. And I think this is one of the advantages at Live Oak. I happen to live where I practiced in Minneapolis, but my team sits 20 feet away from the credit officers. Honestly, if they're having a bad day, we'll submit the case the next day. It can make a difference. Also, we can do much to kind of pre-sell the deal to the credit officers. And they literally talk this way. They'll say, well, I'm not comfortable with the deal the way it is. It's the gut level. But I can get comfortable if ... And then that's a chance for us to come back and work with the buyer and seller and see if it's acceptable to include ... whatever that is, to get the credit officer comfortable. So it makes a big difference being able to work hand in hand as we do with the credit officers to try to get the deal done. Then that'll take us to the, in between those two, to the last bullet point, closing. Closing. What will happen after acceptance is you'll get an offer letter. That's where we say there's a big suitcase full of money just waiting for you. We've got to get to the closing documentation. And for those of you who have closed on a mortgage, this might help you a little bit. I would say triple the amount of work, effort, and forms for closing on a commercial loan. It's a commercial loan. It's a lot of money. It's a lot of hard work. I call it a worthy endeavor. Hard work, but absolutely worth it. So you heard it here first. There is some rigor involved in it. But then we hit closing, and that's when, again, those funds get wired into the escrow account, and that deal gets executed as we had talked about. So that essentially is the process that we'll go through. Beyond that, you'll be involved with a relationship manager who will help you with the loan and any kind of questions that you have going from there, and work very, very closely with you on that. But with that, I'm going to turn it back over to Todd, see if we have any questions.
Thanks, John. This is Tony. I'm going to take it from here. As you can see on your screen, if you want to get a hold of John, you can see John Turner or john.turner@liveoakbank.com or liveoak.bank. And you can see his phone number here, 910-758-2261. And then you can see their website there for some additional resources. And I also want to remind everyone that if you want to purchase the business valuation, then you can go to our website at keymanagementgrp.com. Then under services, select assess your practice, and then business valuation. You can place your order right online. So at this point, what I'd like to do is open it up to some questions. There's two ways that you can ask a question. One would be to raise your hand. You do this on the GoToWebinar control panel, and then I'll unmute your mic and we can talk freely. Or you can type in a question and I'll read the question and we'll do our best to answer it. So let me just pause for 20 seconds here to see if we have any questions. Well, it doesn't look like we have any questions. So Todd and John, you must have done a really thorough job and covered all the information that they wanted to hear. So Todd, thank you. John, thank you for your expertise and for today's presentation. And then for our viewers, thank you for taking the time out of your day to listen to the services that we have to offer, both from Key Management Group and Live Oak Bank. Want to wish you all the well. Happy Thanksgiving, and hopefully we'll see some orders soon. Thanks.